Thank you very much once again to welcome you to Maidstone African Motives, whereby now we are going to uh, discuss or talk about accounting grade 12 under the topic which, which is all about the budgets. So this is the preparations and as well as the revision, as now we are going to write our preparatory examinations. So without wasting much time, we are going to mainly looking at debtors collection schedule. We are mainly going to look at debtors collection schedule. So that is in relation to budgets. As we know, when we are talking about budgets, we are talking about a financial plan that outlines projected income or expenses over a specified period. But when you're talking about the debtors collection schedule, we are talking about it is a tool that is used in budgets to track and predict the collection of debts from customers who have purchased goods and services on credit. So that's what it means. So now we are now going to attend to the questions. So as it says, you are provided with the information related to GNA's stationers. So we are going to deal with stationery. So now we are required 1.1. Why is it necessary to prepare debtors collection schedule? Why is it necessary to prepare debtors collection schedule? So we are to answer that question 1.1. We are to answer that question 1.1. 1.1. So here is our answer book where we are to answer this question. So the question wanted why is it necessary to prepare debtors collection schedule? So it is necessary because a business needs to work out how much cash will be collected each month from its projected sales. This is where we are saying a business needs to work out how much will be collected each month from its projected sales. Each month from its projected sales. From projects that still, so that it can prepare an accurate cash budget to plan its monthly payments accurately. So they need to work out how much will be collected each month from its projected sales. The reason being that they want to prepare and then have accurate cash budget to plan its monthly payments accurately, so that they will know how much they are going to collect each month, so as to be able to pay their monthly payments. So that is that. We know that is necessary because, again, goods are sold for cash and on credit. Goods are sold for cash, cash and on credit. So it means goods are sold on cash basis as well as on credit basis. So that is why we want to know how much we are going to collect from the goods that we sold on credit. So that is the reason why we are to prepare what debtors collection schedule. So that is that. So now we are to move on. Now we are to move on to 1.2. So 1.2 say prepare debtors collection schedule. Prepare debtors collection schedule for the months of January, February, and March 2022 for 3 months. So we are to prepare the collection schedule for January, February, March 2022. So now let's quickly go to the information. Here is our information, whereby now we have total sales. We have the actual total sales as well as budgeted sales. So the actual sales is on these 3 months, October, November, December. The budgeted that we are asked to prepare the debtors collection schedules are January, February, and March. So it also says these are the total sales. It also says credit sales amounts to 65% of total sales. Remember, we have said we are selling both on cash and on credit. So if 65% is on credit sales, it simply says 35% is on cash basis, is on cash. So now it also carries on and says debtors are allowed 30 days to pay. Debtors are allowed 30 days to pay. Debtors pay according to the following trend. Very important, this trend. They said 30% settle in accounts in the month of sales, and they are to receive 5% discount. 45% settle accounts in the following month. 18% settle accounts in the second month of the following of sales. So the provision is made for bad debts in the third month following the month of sales. So now you can see we have 30%, 45%, and then 8%. When you add them, they're going to give you what? 93. So it simply says the 7% is going to be for bad debts to make it 100. So it simply says 7% is going to be the bad debts. So now we are to calculate what? The data schedule for the months of January, February, and March. So before we can go to that, let us try by all means to come to the workings now. Let us come to the workings before we can go and to our answer book. Let us come to the workings. So as you can see, we have said the credit we were told that credit sales amounts to 65% of total sales. And then we have said if so, it means that 5 is on cash sales. So now we are going to say we were given the total sales, if you remember well, the total sales for actual as well as budgeted. So now we are going to say 35% of 23,256,000 is going to give us what? 82,600. Then 35% of 240,000 is going to give us 84. 35% of 360,000 is going to give us 126. 35% of 432,000 then is going to give us 151,200 in January. 35% of 400,000 is going to give us 140,000 for February. 35% of 368,000 is going to give us 128,800 for March. So that is how it goes. But credit sales, we have told that is what? 65%. So we're going to say 65% of 236,000, it will give us what? 133,400. 65,000 of 65% of 240, then it will give us 136,000. 65% of 360, it will give us 234,000. 65% of 432,000, it will give us 280,800. And 65% of 400,000 will give us 260. 65% of 368,000, then it will give us 23,000. It will give us to 39,000. So this is how it goes. So this is how it goes when it comes to our cash as well as credit sales. So as we were told that 30%, if you can remember, we were told that 30% settle in accounts in the month of sales and receive 5% discount. So it means that now we are going to say the first month, now we are going to have what, which is from October when you are starting with the actual total sales, it's going to be 30%. Then follows what? 45%, 18%, as well as what? 7% now, which now we have said is what is bad debts. Is bad debts. But for November, now we are going to start the month of sales. Now is going to be start here as we are talking about the budgets. Now it will be 30%, 45, 18, and then we know for sure now here it will be what? The bad debts. Here it will be the bad debts. So now coming to December now, when you come to December, now the month of sale now is going to start in the month of sale now in December is going to start in December, then goes to January 45, then goes to February, and then March, which is now February 18, and then March we're going to have what? The bad debts. Then coming to January, we are going to start with what? 30%, 45% in February, and then March is what? 18%. It means now these are our 3 months we don't have what? The bad debts. But February, which is the month of the sales, we're going to start by 30%. And then we have what? 45% in March. So March, we are going to have what? The 30% is the month of the sales, because we are going to end in March. Remember, we're told to prepare for January, February, as well as March. So this is how our percentages are going to go and look like. So now let's move on and see how we are going to treat our debtors collection schedule for those 3 months. So it means now it takes us today, takes us to our answer book, and then we see how we are going to treat our 1.2. So here we are now. Here we are now, whereby now we are going to do our work schedules for these months. January, February, and March. January, February, and March. So we are going to calculate them this way. We were told that the 30% settled accounts is in the month of sales and receive what? 5% discount. So before we can just do our calculations, it simply says if the 30% is in accounts in the month of sales and there is a discount that is to be received. So it means to 100%, we are going to say the 100 minus 5, then it will give us what? 95%. So 95%, it means now the percentage that you're going to use on the month of the sale is going to be 0.95. It's going to be 0.95. So now we are to calculate 30% multiplied by 0.95, then it will give us 28.5%. So this is the percentage that we are going to use on the month of the sale, after we have deducted our what do you call our discount, 5% discount. So now we are to start from because now our month of sales now is what? Is January. We are starting with what? January. So it means now we are going to say from November, it's going to be from November, December, and January. So we are going to start with the months that comes before the month of the same. So simple says now, for us to calculate it now, we are going to say, this is where we are. It means you are going to say the month of sales is going to start from November. It's going to start from November. Then comes to December. And then January. Because the month of our sales is what? Is January. Remember, the month of the sales is January. So we are going to start from November, which is the second month. We are going to start from November. And remember, the November is our second month. The November is the second month. And we're told that 18% settled accounts in the second month from the following the month of the sales. So it means now we are going to say 0.18, which is the 18% that we are told about, multiply by 156,000. 156,000, which is now going to give us what? 28,008. So where did we get all this from? Remember, we were told that on the second month, this month, the second month is what? Our percentage is 18%. This is here if we are to go back to that. As we are going to start from our second month, which is this. So that is the 18% that we are using. That is the 18% that we are using. Then multiply by 156,000. Now let's see how we came with that amount. The credit sales for November. The credit sales for November is how much? It's 156,000. One can ask, where did you get that 156,000? We can now go back. We can now go back to here. Remember, we are talking about for people who bought on credit from our business. So here is our 156,000. You remember, we multiply 65% by 240. As we are starting from November, 3 months to go to the month of the same. So here is our 156,000. Hope you understand. Now here is our November, 156,000. So we multiply that by 18% because we were told that the 18% is settled accounts in the second month following the month. So we are going to get what? 28,080. So now we are to write it there for January. Now we are writing 28,008. 28,008. That is that. So now we are moving from now December now. Here now we are in December. So December, we are told that we are going to do what? 45% settle accounts in the following month. So that is where we're now going to say from December. Now we are saying from December, which is what? The following month portion. This one is following month portion. So we are going to say now the credit amount for December. So the credit amount for December is 234,000. 234,000, which is now going to give us 105,300. 105,300. So where did we get this credit sales amount? You remember that this is where we got our from our workings. You remember that 65% of 360,000, it did give us what? 234,000. Gives us 234,000, which is this one. So now, this is where now we are going to write it. 234,000. 234,000. So we multiply our 234,000 by 45%, because we're told that 45% central accounts in the following month. So it gave us 105,300. So that is that. Now we go to January, which is the month of the 6. The collection, remember, is on January. We're told to prepare what we were told to prepare debtors collection schedule from January, February, March. Now we are in January now. So in January, we are going to say from we are going to say from which is January. Now we are told that it's the same month. This one is same month. So same month, this is whereby I have said it that we are going to use this percentage, whereby we subtracted our discount, 5% discount. So it means now we are going to say that is 28%.5, that is 0.285 multiplied by 280,800. Then it will give us 80,000 80,028. 80,028. So here we are going to write the amount for our credit sales in January, which is 280,800. So now we are going to get how much? We are going to get 80,028. So you remember 280,800. This is this amount for January. When you say 65% of 432,000 to get what? 280,800. So we are concentrating only on the total, on the sales, on the credit sales, not chest sales, because we are talking about debtors. So debtors are those people who we sold our stock on credit to. So take note of that. Take note of that. So now we are done with January. So we are to go to February now. We are to go to February. So remember, January, we started from November to January. So with February now, we are going to start from December now. So this one, it was for January. So now we are on February. We are on Feb now. So with Feb, we are going to start from now, from December now. 3 months to February. So we are going to start from December now. Now it's now December. Yes, the December. So let me just write it good. Now we are on December now. So we are going to write December, which is December. We're going to write for December, and then comes what? January. Then here we're going to have what? Feb, which is the month of the sales. So this is how we are going to work it out. This is how we are going to work it out. So now we are going to start from December. So from December, remember our percentage now is going to be what? The 18%. That is where now we're going to start from the second month. We're going to say from December, which is our second month. So let me just, for the sake of space, let me rub here and write it here for month of sales. Let me write it here. So from December, we're going to say from December, which is what now? The second month. It's the second month. It's the second month. So we remember that the second month, it is what? 18%. Same as how we treat what? When we were doing with January. 0.18 multiplied by the amount of December now. Multiplied by the credit sales of December. How much was the credit sales of December? The credit sales of December is 18% of 234,000. 234,000, which is going to give us 42,120. 42,120. So now let's see, where did we get 234,000? Very important. Where did we get 234,000? Here is our credit sales, 234,000. 65% of 360,000 in our total sales. Then our credit sales becomes 234,000. Hope you get it. Hope you get it now. So we are going to, like we have already multiplied this 0.18 by 234,000, then it gives us 42,100. 42,120. So we are going to put it here, 42,120. That is that, when we start by December. So now we are moving on. Now we come to January. January now, that is from Jan. So here from January, we are talking about the following month now. We are talking about the following month now. So then we are going to say 0.45. Yes, you know that is a percentage for the following month. 0.45 multiplied by now the credit sales of January, which is 280,800. Then it will give us 126,360. That is that. So then we go to our answer book and then record it. Where we are to write 126,360. So that is for January. Now we come to February, which is the month of sales. We come to February, which is the month of sales. Now we are seeing from Feb. So the month of sales now, which is February, we are going to write it as sale month. Sale month. Now we are going to say 0.285, like what we did in January, multiply by the credit sales of what? Of February, which is 260,000, which is 260,000, and then we get what? 74,100. That is for February. So one can ask, where did you get 260? Then you can see where we got it from our wikis. Our credit sales for February is 260, as you can see, where we say 65% of our 400,000 give us the credit sales of what? Of 260. From the total sales, from this 400,000 of total sales, there is credit sales of what? 260,000. Hope we understand each other. So now I'm moving on. Now we are done with what? With the February. Now we are to go to March now, which is our last month now, March. So we can just do March here, or let me see. We can go to the next page. Let's do for March. So for March, that is, we are talking about the collection in March. So these are the collections. Remember, when you're talking about this, we're talking about the collections. These are the collections in February. These ones are collections in February. That one was collections for January. So here now collections for March. Collections for March. So here we are in March. Here we are in March. So in March, we are going to start from which month? We are now going to start from January. So it will make January, February, March now. So it means now we're going to start with January. So we are going to say January. We are going to say, let me put it this way. We are going to say from Jan. We are going to say from Jan. Remember, we're talking about the second month. We are talking about the second month. And then you're going to say, from Jan, we're going to say, you remember that the second month is 18%. So we are going to say 0.18 multiplied by the credit sales of January, which is 280,800. And then it will give us how much? 50,544. 50,444. That is that. So now we are to write it in our answer book. Now we are to write it in our answer book. 50,000. We are to write it here. 50,444. Here we are. 50,544. That is that. Now we move on. Now we move on to February now. From Feb, from Feb, which is now following month. So the following month, the percentage that we are given for following month is 45%. So it means we are going to say 0.45 multiplied by the credit sales of February, which is 260,000. So now it will give us how much? It will give us 117,000. Give us 117,000. So now we are to go and record it. So we have what? 117,000. 117,000. Now we move on. Now we go to from now. Now we are saying from what? From March, the month of sales. From March. So March, you know, that is the same month. So same month, you remember that we are going to have the percentage of 0.285 multiplied by the credit sales of March, which is 239,200, which is now going to give us 68,172. 68,172. So that is how we were to calculate them. So for March, maybe we can show you where did we get the credit sales of March here. Our credit sales of March 239,000. So that is that. So now we are to write it, the credit sales of March, which is how much was that? Credit sales of March 68,172, which is 68,172. So that is that. So now we are to do what? We are to add them and get totals, like which we call them payments to debtors. So when we add them together from January, we're going to get 213,408. 213,408. That is January, February. We are going to get 242,508. And March, we are going to get 235,760. So that is that we have answered the question of 1.2, whereby we were asked to prepare the debtors collection schedule for the month of January, February, and March. So now let us move on to 1.3. Let us go to our question 1.3 and see what it needs from us. 1.3. Now we are on 1.3. So the 1.3 read as follows: calculate the total church sales. Calculate the total church sales from January, February, as well as March. That is 1.3. So you remember very well that our church sales is what? 35%. Here we know that we have 35%. So now we are going to say 35% of our total sales. We're going to multiply 35% by our total sales. Our total sales. Then we get what? We will get the total church sales from this month. So now let us go to our weekends. If we can now go there and see. Here are our weekends. Remember our cash our charge percentage is 35% of what? Of the 3 months that we are asked to do. So 35% of 452,000 is how much? It's 151,200. That is for what? That is for January. 35% of 400,000. That is the total sales for February. That is 140,000. Here are the answers. 35% of 368,000 is going to give us 128,800. So now let us go to our answer. Let us go to our answer. Here is our answer book. We were asked to calculate what? Total sales from these 3 months, January, February, March. So we are going to say 35%. 35% multiplied by 432,000. Our total sales for January, 432,000. Like I did show you, then it will give us 151,200. 151,200. So February, we are going to say 35% multiplied by our total sales for February, which amounted 400,000. Then it will give us how much? 140,000. Then come here for March and then says 35% multiplied by our total sales for March, which amounted 368,000. 368,000, and then it will give us how much? 128,800. So that is how easy 1.3 was. So now let's go to 1.4. Let us now go to 1.4. So 1.4, we are asked to calculate the following. Calculate the following: the estimated bad debts to be written off for the period of January to March. Now we are asked to do what? To calculate what? The estimated bad debts from those 3 months, January to February. That is how we are going to, or estimated debts between of the period of January to March. Yeah, that is true. That is that. So for us to do that, for us to calculate that, we are going to, for us to do that, we are going to use our actual total months of sales. We are going to go back to the 3 months, which are the actual months, which is October, November, and December, for us to enable us to calculate it, to calculate the estimated bad debts of January to March. We are going to use the 3 months, the actual months. So we are going to do it this way. 1.3. Okay, 1.3. Okay, 1.4, not 1.3. We are done with 1.3. So this is how we are going to do them. We are estimating what? The bad debts to be written off Jan to March. So the bad debts, 7% of credit sales are written off in the 3rd month of the following month of sales. So with this one, we are going to take what? The 7%, which is the bad debts. You know, our bad debts was 7%. So we're going to take the 7% of the total sales of October, and then sales are going to be what? They are going to be the estimated bad debts for January. Bad debts recorded in January is going to be 7% of October credit. So that is how we are going to do it. So we are saying let me just show how we are going to do it here. We are going to say bad debts recorded in January Let me write it here. Bad debts recorded in Jan is going to be equal to 7% of October. Credit. So bad debts that we're going to record in January is going to be 7% of October credit, which is going to be equal, and then you're going to say 0.07, which is 7%, multiplied by 153,400, which is going to give us 10,738. This is the answer. So how did we get this amount of 153,000? We said bad debts recorded in January is going to be 7% of October credit. So now we want to know the October credit. October credit. So the October credit is what? 153,400. Here it is, 153,400. So we are saying 7% of 153,400. Then it will give us what? The 10,738 that I talked about. When it comes to February, or when it comes to November, because now for February, we are going to the bad that is going to be recorded in February is going to be 7% of what? Of November credit. Same as when it comes to March, we are going to use the December credit. So let's see how we are going to do that. Let's see how we are going to do that. Let's see how we are going to do that. So now we're going to record it here. Here is our 1.4. So it means we are going to write October credit, like we have said. October credit, which is 153,400. 153,400 times our bad debt 7%, which is going to give us what? 10,738. Then when we come to February, now we are going to use what? November. February, we're going to use November. We're going to use November credit. So November credit is what? 156,000. 156,000 times 7%. That is that. So it will give us how much? It will give us 10,920. 10,920. This is for February. For February, we are using November credit. So for March, we are going to use December credit. That's how we estimate them. We are going to use what? December credit. December credit is 234,000 multiplied by 7%, which is going to give us what? 16,308. That's how we estimate the bad debts. So we estimate the bad debts from the previous months. So for January, we use what? October credit. That is for January. That is for Jan. We use what? October credit. For Feb, we use what? November credit. Then we multiply by our bad debt percentage. For March, we use what? December credit. Then that is how we. So now we are going to add this together, and then they are going to amount to 38,038. That is 38 and 38,038. So that is the answer. Now we are moving on to B. The question under B, it says total estimated amount still owned by debtors at the end of March 2022. That is that. The total estimated amount owned by debtors. The total estimated amount still owned by debtors at the end of March 22. Accounts receivable at 31 March. This is why we're saying at 31 March, the outstanding not yet collected and not yet written off. That's what it means. We are saying at 31 March, the outstanding not yet collected, not yet written off. That's what you're going to comprise. So we are going to say January sales remaining is 7% to be written off in April. That is 7% to be written off in April. So meaning we are going to say the credit sales of January, which is 280,800 multiply by 208,000 multiply by 7%. Then it will give us how much? 19,656. That is that. So when we come to Feb, that's when we're talking about the Feb sales. Now we want to know the remaining. Here the remaining was what? Here the remaining was 7% from January. The remaining was 7%. But for Feb now, this one it was for Jan. Now we are coming for Feb. The Feb sales remaining is 25%. We'll see how we came to 25%. So the Feb credit sales is 260,000 multiplied by 25%, which is going to give us 65,000. So for Feb now we have used what? 25%. So 25%, how we came back to 25%, this is where we are going to say, if you can still remember our workings here. Here we are on our workings. For Jan, we used what? Our 7%, which is this one. But when it comes to February, which is this one, we are going to say 7% plus 18. We are now going to add this 7% of debtors plus the 18% that we told that the 18% of settled accounts in the second month. So when you add them, they will give us what? They will give us 25%. They will give us what? 25%. So that is how we calculate it. So that is that. So we added 7% to 7% to our 18% of the settled accounts in the second month. So that is how we came to that. That is how we came to that answer. But now we are coming to March now. We are coming to March now. So to March, we are going to have the credit sales of March is 239,200 multiplied by 70%, which is going to give us 167,440. That is March. That is March. So one can ask, where did we get this 70% from? Very important. We are going to our wikis again. Like I said, our wikis will always help us to know. So here we are. We are going to take now the 7% of our debtors plus the 18% of the settled accounts in the second month. Now with what? Plus 45% of the accounts, of the settled accounts in the following month. All in all, they will give us what? They will give us 70. So that is how we derive to this 70. percent now. So now we are going to our answer book. So here we are. When you say 70% of 239,200, which is the credit sales of March, then it gives us what? 167,440. Now we are to add them so that we can write what? The total. So the total is 252,096. 252,096. So this is our total. So this is the B that we were to calculate. So now we go straight to the question 1.5 and see 1.5 what it needs. 1.5. So here is our 1.5. Here is our 1.5. He said 1.5 is a refer to January sales. It says refer to January sales and then says calculate the percentage in increase in sales. Calculate the percentage increase in sales. That is that. So now we are to calculate what? The percentage increase in sales. So let us go straight to our answer book. Let's go straight to our answer book and see how we are going to answer 1.5a, where we are to calculate what? The percentage increase. So the percentage increase for January, we are going to take what? The total sales for January. If you still remember, the total sales for January is 432,000. So now because we want the increase, for us to know the increase, now we need to know the previous month so that we know that the January increased or decreases. So we want to know the total credit, total sales for the previous month before we get to January, which means now we go to December. So the total sales for December is what? 360,000. So we say minus 360, then we're going to say, because we want the percentage, we're going to say divide by 360,000, then multiply by 100. So this is the total sales for, remember this is the total sales for January. This is the total sales for December. So we want to know the increase in December, how much it was. So when you multiply this, you're going to get 20%. So this 20% is a 20% increase. That is a 20% increase. So let me take you back so that you can make it more clearer and then you understand it. Where are these total sales coming from? The total sales come from here, as we were asked to calculate what? The percentage increase. So here are our total sales. 432, which is our January. So we want to know the previous month so that we know that January there was an increase. So we come to 360,000. So we're going to say 432,000 minus 360 divided by 360 multiplied by 100. So that is that. So hope we get it. So let's go to B. B part said, why are the January sales predicted to increase when and then slowly decline from February? As you can see, February total sales is 400. So it shows that these are the decline. It declined from 432,000 to 400,000. So why was that declining? Why did it decline? So now let's go and get the answer. So here we are to give the answer in B. We are asked about the decline. So our decline you've seen that is 400,000, while in January it was 432,000. So the question was say, why are the January sales predicted to increase, then slowly decline from February? Remember what we were selling? We were selling what? We're selling what? We're selling the stationery. So in February, the stationery. So the reason might be that January is the beginning of the year. You can say that January is the beginning of the year. Is the beginning of the year. Let me write it good. Well, January is the beginning of the year. January is the beginning of the year. January is the beginning of the year before the school starts. Before the school starts. Before the school starts, and they anticipate they anticipate that the demand for stationery will increase. That the demand for stationery will increase. Again, these are the projected sales. So we are going to anticipate that in January, that's when students are going to, or parents are going to look for stationery for their students. So the sales amounts are going to increase. We just predict them that they're going to increase. But in February, they are going to decline because already school have started. So that is how we can answer it. So that is that. Now we are to move on to another question. The question that we are to go to is 1.6. That is 1.5. Then we are to go to 1.6. Now we are to go to 1.6. So 1.6 wanted us to comment. It wanted us to comment on debtors collection policy. It wanted us to comment on debtors collection policy and then give what? The advices. So we are to comment on debtors collection policy. So that is that. So when you comment on debtors collection policy, you can say 75% of debtors does settle their accounts in 30 days. Does settle their accounts in 30 days, which is advised, which is what is advised, that at least make sure that you pay or you settle accounts in a month. Also, the 18% of debtors, 18% of debtors settle their accounts after 60 days. Settle their accounts after 60 days, after 2 months, after 60 days, and 7% of their debtors is written off after 90 days. And 7% of their debtors is written off. Of their debtors is written off after 90 days. after 90 days. And then we can carry on and say, although most debtors are settling their account in 30 days, more can be done with the 18% that is only settling their account after 60 days and 7% written off. So now let's come to the advice. The advice that we can give is that charge interest on overdue. Those who pay very late are charged interest on overdue debtors account. Debtors account. Those who pay even after 90 days, after 2 months, so charge what the interest on such debtors. That is very important. Also, the advice that we are giving is that try by all means to send out statements. Send out the statements before the end of the month. Before the end of the month. For the end of the month. Also, you can also maybe follow up with outstanding debtors. With outstanding debtors. This is the advice that you can give. So that is the end of our presentation. Thank you very much for your time. Make sure that you're going to use this presentation as to prepare for our coming up exams that you're going to write in September for our preparatory. It's also going to be very helpful even when you sit for your final exams that are going to come very soon in October, November, December. So the grade 12s, make sure that we are going to make use of this presentation. It's very, very, very important for you to prepare for your coming exam. Make sure that you're going to share with others and make sure that you're going to hit the subscription button. Thank you very much.